Imagine walking into your favorite store and realizing that your usual groceries, electronics, or even clothing has suddenly become way more expensive. Now, it's not just inflation, there's something bigger at play. The US has recently imposed new tariffs which could silently drain your wallets, shake up businesses, or even impact your investments. But what exactly are these tariffs? Why do they matter? And most importantly, how can you protect yourself financially? Let's dive in. So, what exactly is a tariff? A tariff is basically a tax that the US government places on goods imported from other countries. This means that when American businesses buy foreign products, whether it's steel, semiconductor, or even clothing, they now have to pay extra for those goods. But here's the key point. Businesses don't just absorb these higher costs. Instead, they pass them down to the consumer. That means you. The everyday shopper will start paying more for items that were once affordable. For instance, let's say an American retailer imports smartphones from China. If the government imposes a 25% tariff on those devices, the company will increase the retail price to cover the extra cost, making it more expensive for you as a buyer. With the new 2025 tariffs, we are seeing price hikes on everything, from electronics to groceries. But how bad is it? Now, here's where the problem gets even worse. Tariffs don't just impact a few products. Instead, they drive up prices across the entire economy. Think about it: when businesses are forced to pay higher costs for imported goods, they raise prices on everything to make up for it. This creates a ripple effect. Firstly, imported raw materials get more expensive, means domestic manufacturers raise prices. Then, retailers pass those costs to consumers, means products on shelves cost more, and the everyday expenses range from food to furniture to fuel. You pay more for almost everything. Small businesses struggle. Many local businesses that rely on imported goods have to raise prices or cut jobs to stay afloat. Stock market volatility means uncertainty over tariffs causes huge swings in the stock market, which can hurt your 401k or investments. Then, job market impact means industries affected by tariffs often reduce hiring or lay off workers to cope with rising costs. This in turn contributes to inflation, where your money doesn't go as far as it used to. Your salary might stay the same, but the cost of living keeps rising. And if inflation remains high for too long, it can lead to a major slowdown in the economy. In 2024, tariffs were mainly focused on specific industries like technology, automobiles, and certain agriculture products. Governments were balancing inflation, concerned with the need to protect domestic industries. Some tariffs were left over from the previous trade but weren't aggressively expanded. But in 2025, more goods are facing tariffs, particularly in the sector like electronics, energy, and food. Retaliation from other countries means imported goods are more expensive than before. Government justify these tariffs as economic protection, but consumers end up paying more. A perfect example is the auto industry. Many car manufacturers rely on imported materials like aluminium and computer chips. If tariffs increase the cost of these parts, cars become more expensive, making it harder for people to afford a new vehicle. However, the impact of tariffs isn't just felt by consumers. Businesses and workers also take a big hit. For industries that depend on imports like tech, retail, and manufacturing, tariffs means higher production costs. This leads to tough decisions, like some companies might cut jobs or reduce wages to offset the added expense. Others might move production overseas to avoid the tariffs altogether. Small businesses which have few resources might shut down completely if they can't compete. On the other side, some industries might benefit from tariffs. For example, if the US limits foreign steel imports, American steelmakers might see more demand and higher profit. But overall, these trade policies create a lot of uncertainty in the job market. Take the US farming industry. When tariffs were imposed on Chinese imports, China retaliated by cutting purchases of American crops. This left thousands of farmers struggling, as they lost one of their biggest buyers overnight. For investors, tariffs create a roller coaster of uncertainty in the stock market. Companies that rely on imports like tech and auto manufacturers may see their stock prices drop. On the other hand, companies that produce locally may see gains. Investors often move to safer assets like gold, bonds, and dividend paying stocks during times of economic instability. If you are investing, you need to diversify your portfolio so you are not overly exposed to industries that could suffer from tariff policies. A recent example is Apple. Since many of their products are assembled overseas, any tariff increase on Chinese import could mean higher cost for the company and lower profit for the investors. Now, the big question is, how can you protect yourself financially? Here are 4 smart strategies. Number 1, cut back on expensive imports. If certain goods become too pricey due to tariffs, look for cheaper domestic alternatives or consider delaying big-ticket purchases. You save hundreds or even thousands by making smarter shopping decisions. Number 2, diversify your investments. Don't put all your money in industries that rely heavily on imports. Instead, consider a mix of US-based companies, commodities like gold, and defensive stocks. Your investments stay stable and profitable even during economic uncertainty. Number 3, build a stronger emergency fund. Economic uncertainty is always a reason to save more. Make sure you have at least 3 to 6 months worth of expenses saved up in case of financial difficulties. If tariff hurts your job or finances, you have enough cushion to stay afloat without debt. And if you want to know how to save up at least 3 to 6 months worth of expenses, then watch this video and the link is in the description. Number 4, stay informed and plan ahead. Trade policies change frequently, and keeping an eye on news updates can help you adjust your budget, investments, and financial plans accordingly. By staying informed, you avoid financial surprises and make better spending and investing decisions. The tariff problem isn't just about politics, it directly affects your finances. Whether you are shopping, working, or investing, these policies play a huge role in the economy. So, what do you think? Are tariffs good for the US economy or bad? Drop a comment below. I would love to hear your thoughts. And if you want to know how tiny habits will make you rich, then watch this video.